Welcome to our comprehensive guide on exchange-traded funds, or ETFs. Today, we'll explore what ETFs are, delve into their history, and guide you through how to invest in them, along with their benefits and pitfalls. Exchange-traded funds, or ETFs, are investment funds that hold assets like stocks, bonds, commodities, or a mix, offering a diversified portfolio in a single trade. Unlike mutual funds, ETFs trade on stock exchanges with prices fluctuating throughout the trading day. An ETF is traded on stock exchanges much like individual company shares throughout the trading day. Each ETF is assigned a unique ticker symbol, and its price fluctuates in real time, allowing for the monitoring of its value as the market moves. However, distinct from individual stocks, the total number of an ETF's shares can vary day to day due to the mechanism for creating new shares and redeeming existing ones. This process ensures that the trading price of an ETF remains close to the net value of its assets. While ETFs are designed with the average investor in mind, the role of institutional investors is crucial in preserving the liquidity and accuracy of the ETF's price relative to its assets. Institutional investors manage this through the buying and selling of creation units, which are substantial quantities of ETF shares that can be swapped for the actual assets the ETF tracks. This exchange mechanism allows for the correction of any discrepancies between the ETF's market price and the value of its underlying assets, ensuring the ETF's price accurately reflects its asset value. They combine the diversification benefits of mutual funds with the flexibility of stock trading, making them a popular choice for both novice and seasoned investors. ETFs, like individual stocks, vary in their risk. ETFs can hold more stable stocks, leading to a more predictable but smaller return. Or they may hold more volatile stocks, which can lead to greater returns, but with a greater risk of losses. The concept of ETFs dates back to 1990 in Canada, with the launch of the first successful ETF, the Toronto 60. However, it was the introduction of the SPDR ETF in 1993 in the United States that truly marked the ETF's entry into mainstream investing. Since then, the variety and complexity of ETFs have expanded, encompassing everything from broad market ETFs to niche sectors, including innovative thematic and ESG, environmental, social, and governance funds. There are many different types of ETFs, including index, fixed income, sector, commodity, style, and many more. To start investing in ETFs, you'll need a brokerage account. Once set up, research is key. Look into the ETF's focus, such as whether it targets a specific sector, a broad market index, or a unique investment strategy. Assess the ETF's performance history, fees, and expense ratio, as these factors directly impact your returns. When ready, you can buy or sell ETF shares during trading hours just as you would with stocks, offering flexibility in managing your investment portfolio. ETFs, like individual stocks, vary in their risk. ETFs can hold more stable stocks, leading to a more predictable but smaller return. Or they may hold more volatile stocks, which can lead to greater returns, but with a greater risk of losses. As you begin to research ETFs, you will notice a wide variations in dividends as well. Some are more modest, while some are quite large. This is typically tied to the potential volatility of the assets the ETF holds. Be careful not to be drawn in by the large dividend alone. Research these ETFs carefully to understand their makeup and the outlook for those companies and industries. Flexibility in trading. ETFs offer the distinct advantage of being traded throughout the trading day, just like individual stocks. This contrasts sharply with most mutual funds, which only allow you to buy or sell shares at the closing price of the day. This flexibility means you can react swiftly to market changes, optimizing your investment strategy in real time. High level of transparency. Unlike many investment vehicles, ETFs are often lauded for their transparency. They are typically mandated to disclose their holdings on a daily basis. This gives investors the unique ability to see exactly what assets they are invested in at any given time, providing a clearer understanding of their exposure and risk. Enhanced tax efficiency. one of the more compelling benefits of ETFs is their tax efficiency. They generally produce fewer capital gains distributions compared to actively managed mutual funds. This is due to the unique structure of ETFs that allows for the creation and redemption of shares without triggering taxable events, making them a more tax-efficient choice for investors. Versatile trading transactions. ETFs are traded on stock exchanges, affording investors the opportunity to utilize various order types to manage their investments. This includes limit orders, which allow investors to specify a price at which they are willing to buy or sell an ETF, and stop-loss orders, which can help protect against significant losses. These trading options are not available with mutual funds, offering ETF investors greater control over their investment decisions. ETFs present a compelling option for investors seeking flexibility, transparency, tax efficiency, and a range of trading opportunities. These characteristics make ETFs an attractive choice for both novice and experienced investors looking to diversify their portfolios and manage their investments with precision. Trading expenses. Regularly investing small amounts into ETFs can incur significant trading costs, making it less economical compared to directly investing in no-load funds offered by fund companies. This could be a crucial factor for investors who prefer frequent, smaller transactions over lump-sum investments. Market liquidity challenges. Certain ETFs that do not see much trading activity can have large differences between the buying price, ask, and the selling price, bid, known as the bid-ask spread. This disparity means you might end up purchasing shares at a premium and selling them at a discount, impacting the overall efficiency of your investment. Deviations in index tracking. Although ETFs are designed to closely mirror the performance of their respective indices, there are occasions where discrepancies arise due to technical issues or the fund's management strategies. Such tracking errors can affect the expected performance of your investment in relation to the index. Delay in settlement periods. Unlike some other financial transactions, the settlement of ETF sales takes 2 business days. This delay means that funds from the sale of ETF shares will not be immediately available for reinvestment, potentially affecting your investment strategy or liquidity needs. Understanding these aspects can help investors navigate the complexities of ETF investing, ensuring they make informed decisions that align with their investment goals and risk tolerance. Choosing the right ETF involves aligning your investment goals with the ETF strategy. Consider factors like the ETF's underlying assets, cost structure, and its trading volume, which affects liquidity. Don't overlook the fund manager's reputation and the fund's size, as these can influence the ETF's stability and performance. By carefully selecting ETFs that match your investment profile, you can optimize your portfolio for long-term growth. Exchange-traded funds have transformed the investment landscape, offering flexibility, diversification, and accessible investing to all. With the insights from this guide, you're now better equipped to navigate the ETF market confidently. Remember, informed decisions pave the way to successful investing. Thank you for joining us on this comprehensive journey into the world of ETFs. Ready to expand your investment knowledge? Subscribe and explore more strategies to grow your wealth. Comment below with your favorite ETF.